meantime, I'll leave you in the safe hands of Annabel. Welcome, Annabel.
Thank you so much, Mike. Thank you so much for attending today. We're going to talk about accessing private equity via investment trusts. We're also going to talk a little bit about LTAFs, long-term asset funds. But I always like a bit of audience participation in my panel. Come on, it's like 4:00. It's been a long day. It's been raining. I want to make sure who is awake here. So my question for you, and I can see some smiling, so I'm really glad some people are awake. My question for you is, and I'm going to give you a hint, the average investment trust, its share price total return over the last 10 years is 185%. Pretty good, I would say. Really pretty good. It's having quite a good time. It's gone up about 5% since yesterday when I looked, so all good. My question for you is, what is the average share price total return of the average private equity trust over 10 years? Do you think it's higher or lower than that 185%? And actually, let's be honest, no one apart from me and the panel, who I only told about 2 minutes ago, they didn't know. No one actually knows this answer apart from me. So just guess away or look it up on your phone. Hello. Higher, definitely higher. Anybody want to guess a percentage? 185, do you think it's 200, 300, 250, 250%? Anyone else? 400, 400%. Okay, I'm going to have to say higher.
Like being at an auction.
Thank you so much. But actually, it is higher. It's up 576% over 10 years. Now, I have to say, there is a very large investment trust called 3i that has performed incredibly well over that period. It's very big. It's sort of like a 27 billion company, and it is on a 50% premium currently, and that has performed extraordinarily well. It's up 997%. So we're all kicking ourselves that we haven't invested in that one. But obviously that has got an influence on the whole sector average investment trust. But I do think this is an incredibly interesting time to be looking at private equity investment trusts. And that's what we're going to find out today. Why? Where are the opportunities? How do you go about investing? Private equity investment trusts, I have to say, have been around since the 1970s. So they're very much a tried and tested way of investing in private equity. And they are the best performing investment trust sector over 3, 5, and 10 years. But, there are other sectors that invest in private equity. Growth capital is again, invested in private equity, but they're not taking controlling stakes. So that's another investment trust sector where you can get access to private equity. And actually, conventional, traditional investment trusts like, for example, Scottish Mortgage, that very famous investment trust in the FTSE 100, has up to 30% in unquoted companies in private equity. So conventional investment trusts can also give you some access to private equity. But I think I've spoken enough now, so I want to introduce my panel. And sitting next to me, I'm very pleased that I've got Charlotte Morris. She's the co-manager of Pantheon International, a private equity investment trust, which is 2.1 billion in size. To Charlotte's right, we've got James Lowe. He's the Director of Private Markets at Schroders, and I'm going to be directing my LTAF questions specifically at him. And on my left here, I've got Reg Hoare, who's the Managing Director of MHP Group, which is a communications group, and is a private equity fanatic. Right. What I'm going to do, just so you know, is I'm going to ask the panel a couple of questions. I'm going to ask them like 4 or 5 questions. I then want to take your questions. So I'm hoping we can have a really good interactive discussion here. So first question, and it's a pretty obvious one, but I think we should just ask it, is why should private investors invest in private equity? Why? James is smiling most at the moment. I'm not sure that means he wants to take this question.
I think that given I'm on a private equity panel,
I think
I should be able to answer that question. So here it goes.
I think you should.
Yeah, no. So maybe just taking a step back, I think it's important to look at where we've come from and the growth of the market in private equity. If you look 20 years ago, early 2000s, the private equity market was probably sub $1 trillion in size. So relatively niche as a portfolio construction tool for many private investors. Some people will have had exposure to private equity back then, but it was something that you didn't see across many portfolios. Come forwards 20 years to the 2020s, you look at how large the private equity has grown over that time. We now have a $12 trillion market. So a market that's gone from niche to now what I would describe as mainstream. What's driven that growth is largely institutional allocations through pension funds, sovereign wealth funds, family offices, who have all seen the return profile and the possible diversification you can get in private equity exposures and have added to portfolios. What's really exciting now, I guess, within that 12 trillion market is that it makes up approximately 10% of all equity capital markets. If you think about how large the public equity market is, it's about 100 trillion. So much larger than the private equity sphere currently. But if you put that 10 trillion, that 10% number into context, that shows if you've got zero in private equity, you're now sort of missing out on just the investable universe that is available. So there's a really clear case for private investors who traditionally haven't had as much access to private equity. Obviously, we do have access through the investment trust market to be investing more of their portfolio into private equity and private markets in general. And maybe just a quick expansion of that. Why should I care? If you look at some of the trends that are playing out in terms of how companies are financing themselves globally, companies are staying private for longer. That means that more of the growth of those best companies is happening in private ownership before they even go to listed markets. So before you would see them in your global public markets tracker. And that means that if you want to access the fullest spectrum of companies, you have to start looking at the private equity market. So that's in terms of structural trends that are going on, I think returns, as you've very clearly defined, Annabel, have been super strong.
Super strong.
The market structural trends are moving in a way where more financing of companies is happening in private markets, not public markets. And also, therefore, to get the diversification benefits of that, you need to have an exposure to private equity in your portfolio.
And it's interesting, actually, as well as companies choosing to stay private for longer, and it is a different kind of ownership. It's much more active than what you typically see with listed companies. What another trend, actually, that we've seen in the last decade or so is public market shrinking. So it's the other side of the same coin, really, that if you want to maintain that diversification to the different types of asset out there and the different ways of generating returns that can sort of move in different ways. So getting that diversification benefit is really sort of playing on that trend of shrinking public markets, growing private markets, a bit more active ownership.
And maybe I was just going to quickly touch on that. Sorry, Reg, to interrupt. Just in terms of giving you some numbers around that to show you the magnitude. If you look at the US public equity market and you look at the number of stocks there were on the stock exchange in the 90s, and then you look at today, that number has fallen from around 8,000 to closer to 4,000. So there's been a 40 to 50% decrease, so 40 to 50% decrease in the number of individual stocks that you can access in the public sphere in the US. What that is creating is more concentration in public market indexes. If you look at the US stock market, the UK stock market, around 30 to 40% of those indexes are constituted by the top 10 companies. So it's not that there's not a fantastically large universe out there within that 100 trillion of market cap still. But if you are getting that exposure through an index and you want to be active, then private markets and private equity is a good place to start in that conversation.
Right.
Yeah,
Reg.
for me, I guess lots of the things that James and Charlotte have been talking about, but also this point around global mega trends. Public market companies tend to be in quite mature industries by and large, whereas private market investors tend to be investing more in kind of developing mega trends, either through kind of startup vehicles or, vehicles which are, still quite young and immature, but are growing very quickly. So that gives us access, for example, to things like space travel through SpaceX, which is in Scottish Mortgage, or to AI megatrends, for example, which again, broadly speaking, in the stock market, we're not going to find those sorts of companies. But if we want to get into those areas and kind of, follow that growth trend, then actually buying a private equity or growth capital trust, which holds some of those stocks, then that gives us fantastic access. And at the same time, it kind of de-risks it for us because we don't really know anything about it. But what we do know is that Charlotte and James's colleagues have done probably a huge amount of due diligence on those trends and on those individual companies, and they wouldn't have put investors' money into those businesses unless they were pretty convinced that they were going to be successful over the longer term. So that always gives me huge comfort. I think, okay, those guys at Baillie Gifford, they've done some serious DD on SpaceX, which has given them the confidence to make that a massive holding in Scottish Mortgage.
Absolutely.
I'm happy to go with that.
Absolutely. And not just Scottish Mortgage,
right.
actually.
Yeah.
Edinburgh Worldwide has got a very big holding in SpaceX. I think it's about a 14% holding in SpaceX. And Schroders as well has also got a holding.
Can I just come in here as well? Because I think one thing that often gets overlooked in the conversation about private equity is the diversity of the market and the different types of exposures. So I like to break the private equity universe down a little bit. In the same way public equities can be divided up into, small, mid, large cap, early stage, you name it, different geographies. That's the same in private equity. It's just a different corporate structure and way of holding a company and building a company up over time. When you think about private equity, you should think about it in three main segments, not just one. It should be venture, growth, and then buyout. Each of those different segments have got very different characteristics, different return profiles, different risk profiles. At a very high level, venture, which is, I think, what we're talking about when we're talking about some of the earlier stage, really exciting ideas, generally very fast revenue growth, but possibly pre-profit, great management teams. These are the ones we hear about in the press. Often we think of that as private equity. That is still a form of private equity and can have great returns if you pick the good ones, but is higher risk. A very large portion of the market, and this is where I know that the Pantheon strategy has got a decent focus, and we do at Schroders Capital as well, is in the buyout market. When I'm talking about buyout, and this is a large proportion of the private equity market, this is where these are profitable, small to mid-size, sometimes much larger businesses that just have not gone public. So they have good profit margins, they're growing revenues strongly, they're market leaders in what they do, and they're geographically expanding, and they're working with a private equity sponsor to achieve that. And that is some of those companies are actually quite equivalent to what you might see in a public context. They just haven't gone public. So I think and if you think about what exposure that's giving you, that's something quite different to what you're getting in the SpaceXs of this world and the venture market. It's much more stable, steady returns, and in our view, sort of repeatable over time, versus the venture bit where you're sort of trying to get the really big returns in one go in one company, but some of them might go bust. I think it's really important to just think about it in those three categories because they're very, very different.
I'm wondering what Baillie Gifford would have to say about that now.
They do a very, very good job in the portion they're operating in.
Actually,
I'm just saying there is a specific portion they operate in.
It's equally worth saying some of those buyout, the investment trusts which are more buyout than not, actually get quite specialist in some sectors.
Yes, exactly.
So if you look at Oakley and perhaps ICGT, I don't know about Pantheon, but they do have niches, for example, in software.
Yes.
And areas like that. So if you want to have a bit more of a sector bias through those investment trusts.
HG Capital, the one of the best
services of software
SaaS managers in Europe. We invest with them as a fund manager, as an LP.
Software as a service, absolutely. So basically, I think we've discussed private equity. We've decided it's a good idea. I think from that. I think we've now got to move on to private equity investment trusts, the different types of private equity investment trusts, why you would consider investing in one. I'm going to throw in another surprising fact. Private equity investment trust sector is by far the biggest investment trust sector. It has over 40 billion of assets. Charlotte, let's kick off. What's a private equity investment trust? What do you do?
Well, so as James was saying beforehand, private equity, going back 20, 30 years ago, was quite difficult for an individual investor or a smaller investor to participate in because the structure of it, traditional private equity, is quite challenging. You needed quite significant amounts of capital or significant resources to be able to kind of map the market, understand who you should back. What private equity investment trusts offer is a way of sort of getting around some of those challenges around the amount of capital that you need, achieving diversification, being able to do sort of manager selection, asset selection, by offering a means to invest in an existing portfolio of private companies. So we talked about there's different flavors of private equity. Fundamentally, investment trusts have portfolios of private companies. And what the investment trust does that facilitates the ability to sort of participate in private equity for anybody is to turn that illiquid asset class into something that is available in a liquid format. So you can go and buy a share. So, it could be as small as £3 or £20. You can invest a small amount of money and you can choose how much you'd like to invest into an existing portfolio and have your capital invested in companies right from the moment when you buy those shares. So you go and buy some shares, you can choose whether you think that it's an attractive time or not to invest, and that gives you exposure to an existing portfolio and the expertise of whoever's managing that investment trust, and there are different flavors of that too, but they are doing all of the kind of hard work for you. So as Reg says, doing all of that diligence around companies or private equity managers, choosing who are the best groups to invest with or the best companies to invest within the portfolio, managing cash. So instead of traditional private equity where you commit to a fund and over time that fund will request the capital and you pay it in, and over time it will pay the returns back to you. A trust manages all of that cash side of it for you. So it's the manager is always thinking, where am I getting cash coming back from? What investment opportunities do I have to make sure that the investors, the shareholders' capital is remaining invested in private companies? So that fundamentally is what a trust allows you to do. It's sort of a democratization, if you like, of private equity, making this a liquid asset class available to anybody. You choose when you buy a share. You can choose where you sell those shares. Some of them pay dividends, so you can have an income stream along the way, but it's effectively like holding public equities, but with a private company portfolio underlying that. One other really important feature of investment trusts is that they have an independent board. And so really for any shareholder in that investment trust, the board is representing the shareholder interests. So in the case of our investment trust, we Pantheon are the manager of Pantheon International, and there's an independent board there who have nothing to do with Pantheon, but they are there to always be thinking about the shareholders' interests. They're not getting involved in the day-to-day. We are the manager and we are selecting the investments that go into the trust, but they're there to say, what is the strategy that the manager is putting in place? Are they executing on that strategy? What kind of costs is the vehicle incurring, whether that's to the underlying manager or in operating the vehicle? What's in the best interests of shareholders right now? Is it to pay a dividend? Is it to do share buybacks? And we'll come back to that later. And how can they sort of improve both the NAV performance, so the value of the assets and the growth that's created there, but also the shareholder experience in terms of share price?
Brilliant. Now, can we just move on from that? And I think you have explained quite a lot of the benefits of private equity investment trusts right there, because obviously, as James has already said, there aren't that many options for private investors to get access to private equity as an asset class. I'm just wondering, Charlotte, and please, the rest of the panel, please do pile on in, but if you could talk a little bit about the different types of private equity investment trusts. So obviously some have a fund structure, some are more direct investing. I'm wondering if you could explain that.
So we'll get a little bit into the weeds of private equity. So you have private equity managers like 3i that Annabel mentioned, HG. Those groups are themselves selecting companies to invest in. And a manager that's a fund of funds manager like Pantheon can invest in multiple different managers. So there are two main types of investment trusts that you have within private equity. The ones that are single manager, so HG has a trust, 3i has a trust, Oakley has a trust, that is generally speaking only investing in that manager's companies. So the investment opportunities that they have selected themselves and that they are then managing day to day. Then there are more kind of fund of fund type investment trusts that are multi-manager. So we at Pantheon invest in HG funds, we invest in 3i funds, we invest in IK, we invest in a number of different private equity managers. So as well as being diversified at the company level, we are diversifying across different managers that, as Reg and James have both mentioned before, might bring into play different sector specialisms or geographic specialisms or specialists in a type of kind of operating model. So maybe they pursue a buy and build strategy where they're looking to consolidate a particular market niche. So there's those two main types, the kind of single manager investing in their own companies and multi-manager effectively that's diversifying across different managers and ultimately relying on those managers to be day-to-day involved in their companies and creating value. And one last little subtlety on the fund of fund side is that you can invest in a fund, and oftentimes alongside a fund, you can choose to invest directly into one of the companies that fund is investing in. So we'd call that fund investments and co-investments that are directly into a company. There are some multi-manager investment trusts that are just going into those particular companies. There are others that are just going into funds, and there are groups like Pantheon where we are investing in a combination of funds and company investments directly.
Brilliant. That's a really clear explanation. Now, I think, a lot of people understand they might be experts in private equity, but sometimes it all seems a bit vague, quite honestly. And we actually want to know. And, there have been some scary stories in the media, some frightening things. We actually want to know, what are you actually doing? What are you actually doing to improve these companies? And, what's the plan? And I know there's lots of different examples, but I think it's good to actually get back to that kind of basics. What is going on?
Yeah, and there are, a number of different strategies that private equity managers pursue. At its core, though, it's active management. So that means a manager is looking at every aspect of a company and trying to help the management team, the chief executive, the C-suite, all of the staff there to make that company a better company. And there's different ways that you can do that. That one of the simple ways is in buying well. So buying something at a good price, creating a better company that someone is prepared to pay more for ultimately. So that comes into the sort of valuation that is put onto a business. How do you make it a more attractive company? You might be helping the company to grow into different markets or to win market share and increase the number of customers that they have by doing a better job of whatever their kind of product or service is than others in that particular sector. You could be looking at, I mentioned before, a buy and build strategy. So buying a medium-sized business in a particular sector and then looking for smaller businesses doing a similar thing or something that is additive to an overall platform. So maybe targeting a slightly different type of customer where you're sort of adding smaller businesses, integrating them together and building a bigger company overall. You might have expertise in a particular sort of approach to running your business. So it could be that you bring in experts as a private equity manager who have pricing expertise, or they help with procurement. So how can you get the best set of inputs into your company? Or it could be around talent management. So it may be that a company that a private equity manager comes in to invest in has kind of been run by a founder or a family for a long time, and they need to manage succession. So the manager needs to bring in some new good people to be at the kind of leadership team in that company, and that also can improve the kind of quality and growth of that company. So it's all different ways really to make a company better, help it to grow top line, so increase the number of customers that it has or the total amount of revenue that it's generating, improve its margins, so operating in a more efficient and effective way so that more of that revenue becomes profit, which is still kind of a different flavour of growth. And they use that sort of valuation and the amount of debt that they might use on a company to facilitate that growth over time.
That is brilliant, Charlotte, because we now actually understand what you're doing. That is really good. That is really good. I'm just going to say one more question on private equity investment trusts to the panel. They are currently trading at very wide discounts. Now, investment trusts, you buy and sell them in the stock market, buy and sell at the share price. But of course, you can actually value the underlying assets. You can have add them all up, divide them by the number of shares. You have an NAV per share, which tells you the value of the underlying assets. And they're currently, in the investment trusts, are trading at pretty wide discounts. It's something like 22%, the average in private equity investment trust discount, excluding 3i. And if I tell you that the average investment trust is trading at a 13% discount, you can understand that that's much wider. Now, clearly, partly that discount has to be about lack of demand. I'm interested to go through the whole panel, starting from Charlotte, is what are your views on that? And, is that going to change?
I hope so. And I genuinely believe it will change. I mean, I think discounts really widened a few years ago, actually, where there was a bit of a disconnect in the market between what had happened in public markets, where you saw valuations fall quite dramatically, and what had happened with private company valuations that didn't fall to the same degree. So there's sort of a perception there, well, those private valuations must be inflated. They can't possibly be true, and therefore it should be trading at a discount because I'm reflecting the fact that these companies aren't really valued at the right sort of level. The reality is that private valuations don't really track public markets in either direction. When public markets really rally, private valuations don't go up as much, and similarly when they've kind of dropped significantly, private valuations don't fall to the same degree. They just tend to be less volatile than public valuations. And actually, when we exit companies, when a company's sold and we get the cash coming back from a company's, the proceeds there, what we observe, and it's similar across all investment trusts in private equity, is that the cash that we get back is actually much higher than the last valuation that the manager attributed to a company. And that jump that you see at the point where they sell can be 20, 30, 40% higher proceeds that you get back. So from our perspective, that is a clear endorsement of the valuations. What's really difficult, I think, in private equity, and I think this is what led to that disconnect and sort of still leads to a bit of a kind of concern around valuations that persists until we get back to a bit more of a kind of normal private equity environment, is that, that whole sort of piece of the market where you're sort of waiting for these valuations to come back is something that just you can't really have that much visibility into from an outsider's perspective. So you touched on this a little bit before. Private equity has a reputation for being a little bit opaque, and the information that is shared externally and shared publicly is quite limited. So as a manager of an investment trust and an investor in private equity, we see a lot of the information from our managers, but it isn't something that is shared publicly. So it's difficult for investors on the outside to form their own view of whether the valuations are appropriate or not. So we have strong conviction in the valuations. We see it with these exits that come at an uplift to where the valuation was held. So from my perspective, I think when I sort of mentioned it a little bit, I think investment activity in the last few years has been subdued in private equity. And when you get back to a more normalized environment, I think that's when you'll start to see people have a bit more faith in the valuations, and that should help to narrow the
I think
discount.
that was a key point, wasn't it? That there was less M&A going on within private equity portfolios, and therefore there weren't the exits that verified the valuations that the managers have put on those individual businesses. So, and you can see that in particular with the private equity investment trusts, where there were very concentrated portfolios, typically the ones that were managing their own companies, as described by Charlotte, those two differences. Where if there wasn't an exit in that fund in, let's say, a 6-month period or a 1-year period or maybe even 18 months, there was perhaps good reason to start worrying about, are they ever going to sell anything? Are they ever going to be able to prove the valuation that's been put on it? Even if they claim that it's conservative, the real evidence on that conservatism is when you actually sell the asset.
Yeah, you have to realise really to have a valuation.
Correct.
Absolutely.
Yeah.
Now, I promised James. Can you come in on?
I just come in on? I will in a minute, but I was just going to say maybe I can give a slightly different perspective on the valuation piece. I completely agree with, but I spend most of my days talking to institutional investors about private equity, investment trusts included, particularly the natural larger buyers of the UK investment trusts. So that's the wealth management industry. And I think what's super interesting from a investment trust private equity discount perspective is that to date, most of the large, well-known names, wealth managers that you will have heard of in the market, they don't have a private equity allocation in this asset allocation. Some do, some of the more sophisticated ones, but a lot of them don't. That is becoming more and more untenable because of some of the things we discussed at the start, which is the market is just much larger than it was. And to have a zero allocation is now missing the overall universe allocation of equities. So what we are picking up at a very senior level at some of these larger wealth management firms is that there is a lot of focus on what private markets asset allocations look like going forwards. And my expectation on those conversations, and we're now multiple years into this conversation, it takes a long time to get large ships to move, is that there will be some formalization of private equity and private markets allocations in very large portfolios across the UK wealth market. That is not just going to be implemented in one way, but investment trusts will likely benefit from that. So I think,
That's really
the capital that's going to come into the market by virtue of the whole market being horribly underweight, quite frankly, to this asset class, is going to put new demand into the system. That's my positive perspective on where we're going.
That is really encouraging, but I think you're right. I think it is going to get more demand. I promised James we'd have a question on long-term asset funds, just because obviously the Chancellor announced that they were going to be included in ISAs next year in her Mansion House speech. So can you explain what they are?
Yeah, in 30 seconds I will, because I appreciate we're struggling for time. So the other structure that retail investors are now able to invest into private assets through, including private equity, is the long-term asset fund. It's a new FCA authorized fund. So the FCA created this structure in 21. And in 2023, they opened up access to the retail market. That said, no long-term asset funds were built for the retail market until the end of last year. So you couldn't invest in it until the end of last year. And for you to invest in these types of structures, we will need platforms to offer them. So there's still market infrastructure development ongoing, but there is a new private market structure that exists where new products are being created, which will give you another access point. The final thing I'll say about this is, if you think about where these sit in the liquidity spectrum, and this is key, investment trusts give us the ability to trade on a daily basis on the stock exchange. There's always a price, even if it's a discount. You can get out if you need to. These funds are less liquid. So they are what we define as semi-liquid, which means that they're likely to have more like monthly, quarterly, 6-monthly, or even annual dealing. So they should only be bought by investors who can who have that appropriate time horizon and can take on some form of illiquidity. But for those of you in the room who can, and have a 5 to 10 year life, horizon, on your investments, this could be another structure you could look at.
Thanks so much, James. I'd like to throw it open to you. Have we got any questions in the audience? We've got a question at the back. Question right at the back on the right. Hang on a minute. If you can shout loud, but the mic is coming. You look like you can shout loud.
I'm Haven from Integrate Software. I'm keenly interested in cooperatives and employee-owned organizations. So would investing in an employee-owned SME work if it's a private company?
So only really if there's a sort of portion of the company that the employees are willing to sell. Typically, private equity investors want to take an ownership position where they can have some influence. So it kind of comes back to within the sort of employee-owned element of the shareholding, how much are they willing to sort of give up to a private equity manager coming in? And I say give up, but it's a bit of a quid pro quo because you're giving up some ownership, but actually getting a lot in return from a private equity manager. So I think a lot of, whether it's a founder-owned business or employee-owned business, those are just different flavors of small companies that may be interested in having a private equity manager come in. It could even be a sort of exit route actually for an employee-owned company if all of those employees wanted to get liquidity from the company. So private equity invests in pretty much any kind of private company.
Brilliant. I've got a question here. Oh, there's one there, apparently. And then I've got to come to this gentleman with the pen. And then that's probably going to be it for the questions. But please do ask your question.
Okay. Hi, panel. My question is specifically about the buyout model of private equity. Traditionally, buyout managers have acquired businesses with strong cash flows that they can then add a lot of debt to reduce the amount of capital they have to inject and hence amplify the returns. Now that interest rates are a lot higher than they used to be, how does that affect the buyout model?
I think that's a really, really good question. Super important. So a couple of observations are in a ultra low interest rate environment that we found ourselves in post the financial crisis. It was easy for buyout managers to put lots of leverage onto deals. If you look at some of the levels that were going on to large buyout deals, 6-7 times net debt to EBITDA, what has changed significantly since rates have gone up is that there has been a rebasing of the levels of debt that are going into some of those larger deals. So what was once 6-7 times is now 4-5 times. Really important point here about going back to that segmentation I mentioned earlier. You can even segment the buyout market in similarly to public equities into small, mid, large, and mega buyouts. Just different types of size of private equity company. If you look at the small and mid end of that market, there is a lot lower requirement of leverage. So if you look at some of the investments we're making in the small and mid-sized companies, that's generally sort of a 300 to 600 million enterprise value company. You're more likely to see 3 times debt on that. So it's only a third of the capital structure, which means that the influence that it has on the ultimate returns of that deal is much lower. And so what you're doing in that part of the market and where the focus is now is much more on transforming the company and driving earnings. And then some of the points that obviously Charlotte made around professionalization and making the company more attractive so you can hopefully sell it at a higher multiple at exit.
Thank you. I know we're out of time, but this gentleman really wants to ask this question here. Yeah.
Very quick one. Any comments on charges and how they compare with mainstream trusts on public markets?
Very good question, I have to say. Very good question.
And very topical. The cost disclosure debate is one that's been going on for many years. big picture, costs and fees on private equity trusts tend to be higher than they are on other kinds of investment trust. And part of that is related to the fact that it is an active ownership model. I think the debate has been about, are you double counting in the way that actually costs are disclosed in the sort of, standardized documentation? And that, I think, actually is one of those things that come back to the discount, I think could actually lead to higher demand, because if you can present costs on a more even basis to other sort of competing investment opportunities, then I think it can position investment trusts in a better way. But fundamentally, private equity does have higher costs. I think you have to see that in the context of net returns. And from my perspective, I think those costs are reasonable if you're generating really strong returns. I would happily pay a higher fee on a manager that is capable of delivering 3 or 4 times return on their investment fund. And that's the key to it. Are those managers actually genuinely delivering value and good value for money for the fees that you're paying?
I think maybe just final point of that is, on a forward-looking basis, I think there is definitely downward pressure on fees. The best managers, are still oversubscribed. They're not going to cut their fees. Mm-hmm. But what I've seen in terms of market practice is that fees are coming down as more capital is coming into the market. So, watch this space in terms of where fees are going.
Yeah, and the thing I wanted to say on consumer disclosure of charges, we are expecting an announcement from the FCA in the autumn. Now, we have lobbied very hard for a sensible, pragmatic solution which does not double count charges. Fingers crossed, that's what we get. I'd like to thank you all for participating in this panel. On this panel, thanks so much, James, Charlotte, Reg. Thank you so much for all your questions. I am hoping to see you all at the AIC's Investment Company Showcase on the 10th of October. It's online or it's in person at Liverpool Street. It's free to attend. It's a really, really great event. We have 30 investment trust managers speaking. Anybody wants to find out any details on that, or about private equity investment trusts, or any investment trust for that case, you really should visit the AIC's website, theaic.co.uk. Thank you very much.